What's up, everyone? So, in this video, we're just going to be going over everything about liquidity. I'm going to be going over how I use it, within my trades, or how I can use it, to my advantage within a trade, how to form a trade idea off of it. So, yeah. What I'll first get started off with is just kind of what is liquidity. So, obviously, right here, I have all this text right here. So, what is liquidity? Liquidity is just orders resting within the market. So there's orders literally everywhere in the market. So if I were to look over here at this price chart, every single one of these highs and lows that are formed, every single one of them, there's liquidity and there's orders resting underneath or above each one of these highs or lows. So the way that we essentially use liquidity to our advantage is, since, for example, above highs can be people's stop losses, we look to take out those highs, to take out those people's stop losses, to then take price in the opposite direction. So an example of this would be right here. So we have this high formed on NQ, right? And then we come up and we come just right above that high, and then we start rejecting right back to the downside. So this is what we call a liquidity sweep. So when we see price come up to these highs and then we kind of just start to maybe slow down, or maybe we get an instant rejection back to the downside, that's what's known as a liquidity sweep. So another example that I could use is, for example, over to the left, we have these lows formed right here. When price came down to these lows, as we can see, we came down, swept them out, and immediately rejected back to the upside. So honestly, this is a better example than this one. So right here, we came down, swept out the low, rejected immediately back up to the upside. So this is telling us that there was orders resting underneath here. They got filled, and now we're taking them out as we return back to the upside. So right here, you got to imagine, if people were going long or entering buying positions over here to the left off of any, type of structure, they would have their stop loss most likely underneath these lows, right? So if I drag this over here, clearly we took out their stop loss, right? So now we can continue heading back into that direction. But the same way that people who were in buying positions over here, some people, they'll see us come underneath these lows and they'll start entering into selling positions, and they'll have their stop loss, wherever in this price range. So when we come down, we're making people entering into selling positions, and we're also taking out the people who were in buying positions. So this is what gives us the strength to take a liquidity sweep into our direction. So right here, for example, if we're sweeping out these lows and we have an immediate rejection, we can expect to possibly take price to the upside. We can expect that price, if we're rejecting lows, we could possibly be targeting highs, right? Because, perfect example, we came down, swept out this low, and then we immediately, within the next few days, came up and went up to this high. And then as soon as we went up to this high, now we rejected back down. So this is a perfect example of liquidity sweeps and us rejecting the orders from the market. And like I said, liquidity is everywhere within the market. So I could mark out this high, I could mark out this high, or this high, or this one, or this one, or any of these little minor ones. I can mark out any of these as highs or lows, but some of them will be a little bit more prominent than others. And a way that I would spot that is using equilibrium or premium and discount, right? So let's say if I draw a vertical line right here, let's say I'm looking at nothing from the left past this vertical line, and let's say I'm just looking at this entire price range right here. So if I was looking to take a liquidity sweep to the upside, or even to the downside, I can use the same comparison. If I draw a tool from the top of this range to the bottom of this range, we have this 50% mark right here. So if I have lows that are formed underneath this 50% mark, they would be the most probable liquidity sweeps to take to the upside. Or if I was looking, at this price range right here, where we had this low and this high, and let's say I was looking at, nothing to the left of this black line. if any lows were formed underneath the 50% of this price range, they would be the most probable liquidity sweeps to take. So on the daily time frame, we don't see any lows formed right here. This is just a straight bullish run up. But if I were to go onto the lower time frame, within this same price range, we had these 4-hour lows right here, and they were right underneath this equilibrium, or right underneath this 50% of this range. What did we do? We came down, swept out these lows, and rejected right back to the upside. So using this comparison, like I said, on the daily time frame, I could do the same thing for the selling positions, right? If I take these two off, let's say that I'm looking at from this high to this low, and I just mark it out with this price range. The best liquidity sweeps, or the best highs that I could look to take a sweep of to continue price to the downside, would be any highs that are formed above this 50% mark. So when we have these highs, and we have these highs, and these, and this high, these are all the most probable highs to take a liquidity sweep from to the downside. For example, this high, if you can see, we had this move down, and then we had this move up. It's a very tiny candle, but it was a move up candle. So this is a high. This high got completely disrespected, and this was underneath the 50% of this price range. So this is just a clear tool that can kind of help you get rid of all the extra noise, because, for example, on a lower time frame, there's highs everywhere. We have these highs, all of these highs that are formed, right? So going on to a higher time frame, or marking out, your price range that you're within, can kind of help you get rid of the ones that you shouldn't be looking at. So that's a way that you can spot, the most prominent liquidity. But now let's go a little bit more into these terms. So obviously we covered liquidity. It's orders resting within the market. So, it's everywhere. We have lows, we have highs, it's orders resting above or below highs or lows, or even within, highs or lows. There's liquidity everywhere. So next thing that I would go into is, what is buy side liquidity? So nothing special about it. Buy side liquidity is just the liquidity that is on the upper half of price. So for example, if I took off these tools, any highs are going to be buy side liquidity. So all of these highs, these are all buy side, because they're on the buying side, on the upper half of price. We need to buy to get up to them. And now for this second term, we have sell side liquidity, or well, third. We have sell side liquidity. So any sell side liquidity will be the lows on the lower half of price. So we have, for example, this low, we have these lows, or these lows, this low, this low. All of these lows that are on the bottom half of price, or the selling side, meaning we have to sell off to get to them, these are all sell side liquidity. So that's just a basic way of where you can kind of differentiate, if somebody's talking about buy side liquidity being swept, you can expect that we're sweeping out highs. We're sweeping out buy side liquidity. And if somebody says that we are sweeping out sell side liquidity, we can expect that we're sweeping out lows to continue to the upside. So, for those two terms, that's what buy side and sell side liquidity is. Now for the next one, we have equal highs and equal lows. So equal highs and equal lows is highs or lows resting near or directly on top of each other. So a way that I can actually, I see a perfect example right now that I can show it to you. So like I said, equal highs or equal lows are highs or lows that are directly on top of each other or right next to each other. So right here on the daily time frame, we have these two highs formed right here. We have this move down and a move up and a move down, and we have another move down and a move up and a move down. So every move down and a move up, and every move up and move down forms highs and lows. So we have this high, but what do we also have? This other high. And if I made these a little thinner, we can clearly see we have this high, and we also have this high. They are very closely stacked right next to each other. This is one of the highest probability forms of liquidity that you can target or take a liquidity sweep off of. So say if we're in a long bias, meaning that we want to enter into a buying position, a target for us can be a target up to these equal highs right here. And if we were looking for equal lows, if I can, find some over to my left, right here, for example, we have this low formed and we have this low formed. These two lows are right next to each other. They are pretty much on top of each other. They're not directly on top of each other, but you can assume what I mean. So when we're looking at equal highs and equal lows, they are just the liquidity that is directly on top of each other or resting directly near each other. And they are very high probability targets for price. So I deleted my text back there. But anyways, yeah, it's just, name kind of explains itself. It's just highs or lows that are equally next to each other or directly on top of each other. So for the next term, we have data highs and data lows. So this is not to confuse you of, oh, well, where are we getting the data from or any of that stuff. What we're just looking at is large candle wicks that are created by news events. So if you've been trading for a little bit, obviously you'll know that we have news events that come out. We have, 8:30 news, we have 10 a.m. news. We have all of these different news events that come out. And you can find all of these news events on this website called Forex Factory right here. It shows you all of these news events that come out. So data highs and data lows are essentially, like I said, just large wicks created by news events getting released. So if I were to go onto a lower time frame, and I was going to go at yesterday's price action. Right here, this is the New York Stock Exchange Open, this red line right here. And this candle right here, this is a news event getting released. So if I, clear every other candle, we can see that when this news event got released, it created two very big wicks of this candle on both sides. So when we're looking at price, the data highs or data lows, which is what these are called, are good targets for price, or a good price area that price can reject off of. So let's say we're looking at price right now. The news event just dropped and we created both of these wicks on both these sides. We can expect that price is going to draw towards either of these sides. I mean, it's going to have to take out one side eventually, right? Because we're stuck within this price range. So as we see, price comes up, and we take out the data high. Now this is important. We come up to this data high and then we immediately reject back down. So we're not just continuing to the upside. We're not just continuing forming higher highs and higher lows to the upside. We came up to this high and are essentially rejecting immediately back down. Now, it won't always be an immediate rejection. For example, if you're taking a higher time frame liquidity sweep, the rejection on a lower time frame isn't going to always be instant because you're taking it off of a higher time frame level. It has to make more of a significant move on a higher time frame to support your lower time frame trade idea. So, for example, right here, we have lower time frame highs. So if we're looking for a rejection, we would want it to be pretty much instantly. If we're looking at a lower time frame, we don't want these to just keep getting disrespected and still take a trade off of them. We would like to see the rejection come pretty fast. So we can see, we come down, we come right back above those highs, and we reject right back down, right? So now, once these data highs have been taken out, it's a chance that we can target these data lows. So with whatever concepts that you would use within your trading, to formulate your trade idea, rather it be fair value gaps or, order blocks, whatever concepts that you're using, you can now see that we swept out liquidity and now we can take price to the downside. So if I just let price keep on playing, now actually this might not be the best example. NQ on MNQ right here, it did not take out the lows, but on another pair, it did take out these lows. So just imagine that these, these lows are taken right now. But just as the example, when we take out data highs, we can target the data lows. Vice versa. If we take out the lows, we can target the highs. It all just flows into itself of kind of the liquidity that you can target. It's the, and the data highs and the data lows, they're not always necessarily going to be something that will 100% form your trade idea, but it's a very high probability target for you to aim for within price. They get respected and they get taken out a lot. So if I were to, go out of here, that's what data highs and data lows are. Just like I said, it's just news events getting released and creating very big wicks on either sides of candles. So getting past that, now we have low resistance liquidity. So I look at low resistance liquidity possibly a little bit different than how some other people will look at it. I look at low resistance liquidity as highs or lows that are formed that aren't rejecting previous highs or lows. So let's take now I can just, since I covered everything, I'm just going to delete that. Let's take this for an example. Right here within this area right here in price, we have all of these highs formed right here. But if I mark out every one of these highs, for example, this move up and this move down, that's a high. We have this move up, this move down, that's a high. I don't need to keep repeating myself. These are all highs right here. If you notice, none of these highs are running previous highs. If I were to go into a lower time frame, this high didn't get taken out by this high, and this high didn't get taken out by this high. Same way that these highs didn't get taken out by this high. So this is what's known as low resistance liquidity. This is liquidity that isn't having resistance. I mean, it kind of explains itself within the name. You can also use this the same way that you can use data highs and lows. You can use low resistance liquidity to support your trade idea as a target, or you can take a trade after they've been swept. So let's say we take out all of this low resistance liquidity. We can look to take a trade to the downside. And let's say we're inside of a buying position right where price is at. We can use these low resistance liquidity as targets for price, because a lot of the time when we have the low resistance liquidity or highs that aren't rejecting previous highs, you have to imagine there is stop losses above every single one of these highs. We have stop losses up here, stop losses up here, stop losses up here, a bunch of stop losses up here, right? So we're not going to keep these intact forever. We're not going to let these people make money forever. We're going to take them out of their positions eventually. So that's how you can use these as targets for price, because you're aiming to take out people's stop losses. So I didn't have this written down on there, but now that we've went over what low resistance liquidity is, now we can go over what high resistance liquidity is. So we can see right here, none of these highs were being rejected by previous highs. We were just continuing to print lower and lower and lower. But if we look right here, within this area of price, right here, what do we see? Price formed this high, and then formed another high. The second high that was formed took out the first one. This is what's known as high resistance liquidity. It is highs or lows that are being formed that are being respected and are being rejected. So we are coming up, right? And when people have their stop losses right here, we're coming up, taking out those stop losses, and continuing back down. Compared to right here, we haven't taken out these people's stop losses yet. So whoever is in a trade to the downside with their stop loss right up in here, they're still within this trade, and they're still making money right here. But down here, we didn't allow these people to make money. Anybody who was in a short position right here and had their stop loss right here, we took them out. So this is what's known as high resistance liquidity. So if I were to show you another example right here, we have lows formed, lows formed, lows formed. we form this low right here with this move down and this move up. We have this low formed, and then what does price do? We come down and sweep out this previous low. This is known as high resistance liquidity. Like I said, we are rejecting previous highs or lows that have been formed and supporting price to the opposite direction. So this is high resistance liquidity, meaning that we are taking out people's stop losses. We have taken them out. If people were in a buying position here with stops underneath this low, they are out of their position. Here, we're not taking these people out. This is low resistance liquidity. We're not rejecting previous highs or lows. This is high resistance liquidity, where we are rejecting previous highs or lows. So, yes. So, that's really everything about liquidity. It is a very simple topic. It's just kind of different ways that you can use it in, and different, specific ways that you can use them as targets. Not to repeat myself, but it's very simple. If you're having troubles finding the prominent liquidity or the liquidity that you should be taking a sweep off of, like I said, use a tool that can help you identify the whole entire price range that you're stuck within. So if I'm looking at this price range, just for one more time, if I'm looking at this whole price range right here, the best highs to take a liquidity sweep of, to take a sweep to the downside, are going to be above this 50% mark. So these highs up here would be the most ideal highs to take a liquidity sweep to the downside. In the same way that all of these lows that are formed underneath the 50% of this price range are going to be the best lows to take a sweep of liquidity to take it to the upside. So it all flows into each other. I hope you understood, and yeah, it's everything about liquidity.